All right, welcome back to the weekly wrap where we cover everything that's happening in Chinese markets, both on the mainland and in Hong Kong. And if you're listening for the first time, thank you and welcome. This is our fourth episode on YouTube and our first episode that's going to the podcasting world. So if you're tuning in there, thank you very much and welcome. We cover the last week that's happening in markets. So what's happening on the mainland, major economic news, major market news, major stock news. Last week we covered a whole bunch of earnings reports, particularly Yum Brands China and Alibaba, but it has been a very, very strong week for Chinese equities. As always, there is a lot of news that's happening in the second largest economy in the world, and still, in my opinion, the most influential and most important economy in the world. So without further ado, let's get into it. If you're listening on YouTube, this is our fourth episode. If you don't mind, hit that like button and hit the subscribe button. And if you're listening on podcasts, where you get your podcast, welcome. We're still formulating a plan, still getting out, working out how this is going to work. This is only the fourth episode, but it is coming along well when we did well in terms of viewership last week. Before we get started, let's just begin with a disclaimer. This video and contents are provided for information purposes only, does not constitute a recommendation to purchase or sell securities. Remember, it's not intended to be financial advice, no representations or warranties or guarantees. I try to keep it as factual as I can and up to date, but I make mistakes and sometimes it's not completely accurate or up to date. And I guess the biggest thing here is these are my own opinions. They're not personal advice. They are simply my own opinions. You may agree or disagree with that, but I welcome the debate. And with saying that, let's get into it. So what we're going to talk about today, we're going to talk about quick hits, new little segment that we're going to introduce, just some little headlines that I will comment on and inform you about that happened within Chinese equities. We're going to take a look at market performance. We've come back to a full week after the Lunar New Year where mainland markets were pretty much closed for the whole week. So was Hong Kong. They were open for a couple of days. We're going to look at the Lunar New Year travel numbers. A big indication of where China is. If your consumers or your citizens are traveling, then hopefully they're consuming, and consumption means economic growth. And we know that economic growth is made up by companies who are listed on the stock exchange, and therefore that may entail a rise in the exchange. If you're an investor in Chinese equities, this could be a good thing. It also could be a bad thing depending on the numbers. They were mixed. I thought they were quite positive. There was some negative sentiment out there, but you tend to have that with China at the moment, rightfully or wrongfully. We'll see. Rate cuts. So we saw a cut in the 5-year rate, which is really their headline rate when it comes to home mortgages. That was a big move, biggest move in history. And we'll cover that. We'll cover the national team. So we hear a lot about the national team. We've mentioned it a lot on this program. The national team coming in, buying up ETFs, supporting the stock market under the guise of the CCP, or the regulators, who are the national team. And we'll give you some stats on what's been happening in relation to their buying of equities. We'll also talk about some market moves or some regulator moves to ensure market stability. Last week, if you haven't checked it out, we did a whole, section on what the Chinese regulators, what the government was doing in order to stabilize the market. We saw a movement on one of those issues during the week. And we're also going to talk about semiconductors and chips. We're going to do that off the back of, believe it or not, a Japanese stock report, and just talk about the Chinese chip sector and why I think it's actually a sector that I want to be invested in and am invested in. And of course, this is not advice. If you haven't already and you're listening on YouTube, please give us a thumbs up and a subscribe and give us a comment on the comment button. And if you can give us a 5 out of 5 rating on podcast, that would be lovely. All right, let's run through quick hits here. A little bit of a new kind of segment, just some major headlines or minor headlines that affected the stock market during the week. The first one was Meituan Dianping, if you don't know who that is, one of the biggest tech companies within China, operating at 4-year lows, around roughly the 75 mark at the moment. Think about it as like an Uber Eats, but they also integrate on the vendor sides, like with businesses, kind of like a Square terminal without taking the payment. But they are starting to jump into that. They also do hotel bookings, travel bookings, etc. Very big company, one of the major tech companies, one of my favorites actually within China. They had a good week in terms of share price, and that was off the back of a report that their delivery numbers saw a big jump in mail orders on the year ago since Lunar New Year. So some of those numbers coming out of Lunar New Year. We saw mainland China log actually 7 positive days. It's got 6 there, but it's actually 7 if you include yesterday's move, Thursday on the Shanghai Composite and the Shenzhen. So, a really good run for Chinese equities, which we'll discuss in a moment. We saw 1.89 billion of net equities, or of net buying on ETFs being bought, which is an indication that the national team continues to buy, and is also an indication of the rumors that overseas state-owned enterprise profits would be steered through the Connect. So the Connect is what we're talking about from Hong Kong into the mainland, and that is the southbound Connect. Yeah, should be the southbound Connect. So SOE, and so state-owned enterprises, overseas profits, overseas, taking that money, pushing it through Hong Kong, and then buying mainland stocks. So a massive net inflow on Wednesday, which was a big day for markets within China. We also saw Ping An real estate, which I thought was indicative of the stabilization that's coming into the property market, which is going to be key if China is going to recover, and certainly if its stock market's going to recover from 4 to 5 year lows, depending on what exchange that you're looking at. So the Ping An real estate, which is the property investment arm of China insurance giant Ping An Insurance, received a lifeline from its sister company of more than 8 billion. This was reported by Reuters. The board of Ping An, the banking unit Ping An Insurance, has approved the issue of a 1-year credit loan of RMB 8 billion, roughly about 1.1 billion US, to Ping An Real Estate, the bank said in a Monday filing. So shoring up that market, and I think, that's, maybe a suggestion of the regulator and a suggestion of the government, but also it's to get some of these houses built, which I think is a key component to stabilize that market. We've seen a lot of this over the last couple of weeks and months, issues of funding. There is a government kind of task force where they're asking state-owned enterprises to, provide some liquidity to these developers so they can get these properties built, so they can restore some confidence in the Chinese consumer who doesn't trust that developments are going to get built. And when you don't trust that developments are going to get built, you don't invest in property markets. Cover that a little bit more when we talk about the LPR rate. Chinese e-commerce giant Alibaba Group has sought to partner with firms in Saudi Arabia as well as Dubai. So Alibaba's president or global president, Michael Evans, one of the things we've chosen to do, which is a little unusual for a Chinese company, is we partner with areas around the world. So, move for Alibaba to get into the Middle East. We talked about their overseas numbers, particularly in their e-commerce sales of Lazada, and I remember AliExpress is their global one, up 60% year on year. So another move there. And then smartphone maker Oppo, which is a decent phone. I was actually at a little party where people were talking about that. Issued a bit of a white paper saying that 50% of smartphones by 2025 will have some type of AI in there, issued within the Chinese economy or within the Chinese market. And I thought, that was a good indication of how advanced actually Chinese phones are. You talk about Oppo, Xiaomi, Huawei. These are great little phones that are actually, up there with the likes of Apple in terms of security, safety, and also technology. So that's a little bit of some headlines out of the Chinese markets during the week. Let's go through to performance. So a fairly good week for market performance within China. Cover the 3 major indexes here. We're going to do the SSC Composite Index, the Shenzhen Composite Index, and the Hang Seng Index as we go along. And these are brought to us by TradingView, www.tradingview.com. As we go along, we'll get more. I really want to get the star market on there and a few other indexes, maybe the A50. But let's take a look at the week performance. 5.5% positive move on the SSC Composite Index. We talked about mainlands having 6 days in a row of positive gains, 7 actually. This is the last 5 days. So we're essentially going from the 22nd of February, because it's 23rd of February and Chinese markets have not opened. I'm filming this at 7:42 a.m. Sydney time. So good morning to everybody. So the last 5 days back from there, trading days. The Shenzhen Composite Index for performance for the week, 3.35, and the Hang Seng, 5.81. If we just push it out for the month, SSC Composite now 8.79 positive, Shenzhen 6.84, and the Hang Seng up 11.34% for the last month. So that would be 22nd of February back to January 27th. So a fairly good month. And outperformed probably the US markets, considering that's been a bit choppy, although last night was a big move on the back of Nvidia earnings, which I haven't detailed what they talked about China yet. So it'll be interesting to read through that as we go through the week. So a very good week for equities and a very good month for Chinese equities if you're an investor in Chinese equities, as I am. But, if you look at the 5-year performance, Hang Seng down 18.38, Shenzhen up 7, and the SSC Composite up 8. And the last year, if you look at the Shenzhen 1-year performance, down 23.95. Just a fun fact, year to date, they're all still down with the exception of the SSC Composite Index, which is the Shanghai Stock Exchange. If you don't know what that acronym means, that's actually up 0.52, but the Shenzhen is down 5.07 and the Hang Seng is 7.18. So trailing definitely the US, definitely Europe, and definitely Japan. And definitely emerging markets like India, which we talked about a little bit last week. All right, let's run through the travel numbers. Very important. This is the biggest human migration that occurs on a yearly basis around the world, and that is pretty much the Chinese Lunar New Year, or the Lunar New Year, I should say, and the Chinese version of it, the Year of the Dragon this year. And basically, this is where you get, the hundreds of millions of people that have urbanized, go back to their home cities or regional towns and celebrate with their family and friends. And there's also a lot of partying, there's a lot of public holidays, week off for the stock exchange, certainly a big week. So travel numbers are important because they kind of give us an indication of the Chinese consumer. How strong are they? What's their dispensation to spend? And we understand that spending is an important part of an economy because spending leads to job creation or investment by firms, which leads to further job creation, which leads to higher wages, which leads to more spending and that cyclical effect. And you would assume that if people are spending more, companies are making more money, and therefore their fundamentals of their stocks are better, and therefore their stock prices will rise. So increase to 47.3% year on year, surpassing 2019 levels. So best levels since 2019. Obviously, we know what happened after that. That was the pandemic. Domestic travel boom contributed to this surge, with domestic tourism spending reaching 632.7 billion yuan. The number of domestic trips rose 34.3%, and I'm taking it this is on the back of 2019. However, and this is where some of the negativity came in, despite the increase, average spending per trip was down 9.5% from 2019 levels. Whatever. In fact, Brendan Ahern, the Chief Investment Officer of CraneShares, says whatever. And when he talks about this, international travel also saw growth with around 13.52. We talked a little bit about this in last week's episode. And box office revenue. So people going to the movies was massive. So box office revenue exceeded 8 billion yuan, setting a new record within China. So the movies are quite strong. And it's probably, a thing that you do. You go around to the movies, when you got holidays on, you watch it with your loved ones, etc. But an indication that the Chinese consumer is getting a little bit stronger and a willingness to spend. I think the domestic trip number is really good. We did see a bunch of domestic trip companies or booking companies or tourism companies really bounce off the back of this. Of these numbers, which indicates, their earnings and their profits are going to be better as they start to report quarter on quarter because of this. So 474 million trips, which is a 34.3% rise on the 2019 numbers. And we take the 2019 numbers because, they were pretty much closed till the end of 2022. and then you had that big reopening. So they were closed a lot longer than most major economies in the world because of lockdowns, etc. I thought they were reasonably good numbers. If you wanted to be negative about it, you would talk about the average spending per trip down 9.5%. However, I think the considerable growth that they've had, and I think it's part of this dual circulation program where they want to promote domestic spending and domestic tourism. I think that's great, and you're certainly starting to see a lot of Chinese tourists travel overseas, which is an indication that the consumer is strong, and is also good for the global economy. All right, so probably the biggest announcement that we saw on Chinese markets during the week was the rate cuts. So the People's Bank of China, which is their central bank, equivalent of their Reserve Bank, announced on Tuesday that it would cut its 5-year loan prime rate, their LPR, from 4.2% to 3.95%, while keeping the 1-year LPR unchanged at 3.45%. The reason why this was big news was because the 5-year LPR is kind of your headline rate when you're looking at a mortgage rate. Let me put this differently. If you're a Chinese consumer and you're going to the bank, or you're thinking about buying a property, and you might be talking to your wife or your family or etc., and you're like, okay, what are we going to base our repayments on? You usually base it on the 5-year rate. So it was a specific move by the PBOC, a targeted move at the 5-year LPR rate. This system was revamped in 2019. However, the 25 basis cut to the 5-year LPR is the biggest reduction the central bank has made since the revamp in 2019. The latest cut was also the first reduction to the 5-year LPR since June 2023. So when I say biggest rate, they've moved by 0.1, 0.15, I believe, previously. Never by such a rate at 0.25. They have been very reluctant to move these rates, or move them with any gusto, because they are wary of debt bubbles within the Chinese economy. Part of the reason we're seeing the property market where it is a move by Chinese regulators, by the Chinese government, and by the Chinese banking system in order to remove bad debts within the Chinese market. You got to remember what started all this was the Chinese regulator, the PBOC in particular, coming out and saying to developers, you could have, taking numbers out of the air here, 60% leverage on your properties. Now you only can have 40%. Therefore, that led to property developers searching for money from SOEs, which they couldn't get because they were over the threshold anyway. And that's when you started to see the effect of properties not getting built, and that cascading effect that we've seen in the market. The LPR rate, which I've always remembered, is the rate at which commercial banks lend to their best customers, and the 5-year rate usually serves as a reference for mortgages. Didn't really get the kick that we thought it was going to do in markets, but it come off a couple of strong days, and it certainly has kicked on since then. On Wednesday, Thursday, and we'll see what happens Friday today when we're filming this, but it's probably going to be a strong day considering when I woke up this morning, the Nasdaq was up 2.95%. But I have my views about how that market is a little bit overpriced. But this is an episode or a show about Chinese stock markets. All right, I wanted to mention this one here. We often hear about the national team. We've covered this a little bit in previous episodes. We talked about market stabilization, and one of those areas was the Chinese Sovereign Wealth Fund coming in. I want to pronounce its name, but I'm worried that I'm going to get it wrong. It's Hua. I'm not going to say it. Them buying Chinese assets, particularly ETFs, and stabilizing the market. The other one is the Chinese national team. You will hear this or read this in articles or videos that you watch, and you certainly heard this in the 4 episodes that we've talked about here on the China Financial Markets Analysis channel. I really need a new name for that. Actually, I haven't even pinpointed what the name's going to be, but we're working through it as we go. Who is the national team? Well, the national teams are asset management companies within China, obviously regulated by the Chinese regulators there. And the four major ones that we look at are eFund Management, which is a Chinese asset management company founded in 2001, considered the largest asset management company in China. NA is missing there, my apologies. Roughly 420 billion US dollars under management. Huate Pine Bridge Asset Management, established on November 18, 2014, is one of the nationwide fund management companies approved by the CSRC, which is the China Securities Regulation Commission. Roughly 220 billion US dollars under management there. China Asset Management, 271 billion US dollars. This is a company that offers investment managers of the National Security Fund, corporate annuities, listed open-end funds, qualified domestic institutional investor funds, and qualified foreign institutional investor funds. And the last one is Harvest Fund Management, 230 billion US dollars under management. They're the two big four that you look at when we talk about the national team coming on and buying assets. Very important because they tend to be long-term holders of the assets that they buy, and they are providing some stability to those markets. According to Bloomberg, as of February 9, those national team, their five top ETFs, so their combined five top ETFs holdings was US 79.2 billion on February 9. So they held 79.2 billion US dollars worth of the top five Chinese ETFs, mainland ETFs, right? So these will be a combination of, one's tracking the A shares, the Shenzhen composite, possibly the star market, some of these exchanges within China. The key component that I would like to say, so I'll just repeat that, and this was printed by the SCMP. Net assets at the nation's top five managed by eFund Management, Huate Pine Bridge Management, China Asset Management, and Harvest Fund Management stood at $7.92 billion on February 9, according to a report published by Goldman Sachs. I think I quoted Bloomberg previously. That was incorrect. And that was printed in the South China Morning Post. There's a link there for you if you're on YouTube. But here's the key component. So they're at 79.2 billion on February 9. If you look at the five ETFs that track the CSI 300 index and the Shanghai Stock Exchange and the top 50 stocks, their reported combined net assets held by some of these. So they had 339 billion at the end of 2023, which is 47.1 billion. So they're at 79.2 billion at February 9. So massive intake. They had 194 billion in June 30 and 185 billion in March 31 last year. So I'll just say that again. March 31 last year, they had 185 billion yuan. June 30, they had 194 billion yuan last year. At the end of 2023, they had 339 billion yuan, or 47.1 billion US. And then as of February 9, they had 79.2 billion. So almost doubled within the last 3 months, and certainly, nearly tripled since March last year. And that source is from Bloomberg, is what I meant to quote. So a massive inflow of funds by the national team buying up Chinese assets. Why is this important? One, it adds stability, and two, I will continue to reiterate, you will think they are long-term holders. Therefore, they're not selling and not creating liquidity for selling, and that could help prices, or should help prices, particularly if you have a wave of buying coming in. So I thought it was important to cover that. So just to recap, the national team, when we talk about them, four major ones: eFund Management, Huate Pine Bridge Asset Management, which is actually a merger of those two companies, China Asset Management, and Harvest Fund Management. If you look at them all together, roughly about $1 trillion under management, a bit over, and that's US. All right, so we saw more moves by the Chinese to stabilize the market again, and this is by putting in some rules and finding some companies around their, what they call, I wouldn't call it market manipulation, but doing things that they don't want them to do. And we saw that during the week where, and this was on Tuesday, where a hedge fund called Lingjun which manages more than 60 billion yuan, they were fined and banned from trading for 3 days as part of a wider regulatory efforts to revive the market. Now, this was printed in Reuters. So Chinese quant funds, which utilize derivatives and data-driven computer models, face setbacks from market sell-offs and government restrictions on China selling. They were fined and banned, so Lingzhuan faced a 3-day trading halt due to violating rules against endangering exchange systems or normal trading order. Lingzhuan dumped 2.57 billion yuan, or 357.4 million US dollars, in A shares in a minute, leading to strengthened monitoring of quantity, especially high frequency trading. So they dumped right on the close, leading to losses. The regulators saying that high frequency trading could contribute to market volatility, prompting regulators to seek tight security. So they were hit as kind of a warning to the rest of you. Don't break the rules. They kind of talked about these, but never enforced them early on, but they are starting to enforce them. I think this is the poster boy of what is happening there. The company apologized. They were banned for 3 days. And then what we saw following from that is a further move, and this was a move that was brought on. So the regulator came out and they banned major institutional investors from selling equity holdings during the first and last 30 minutes of exchanges of trading to support its $8.6 trillion stock market. All right. So you can't sell during the first and last 30 minutes of trading support. Right, and that's to prevent that herd selling, which we saw a couple of weeks ago, where the market just falls off a cliff as the markets climb. Because I think you've got stops. We talked about snowball derivatives that sit in between exchanges. We also talked about CBBCs, call and put warrants on the Hong Kong market. And stop losses. You get those stop losses triggered because of these big institutional sellings, and then it's just the cascading effect. Stops get hit as you go along. They're trying to prevent that, particularly in the first and last 30 minutes. And you can see how you could manipulate that. So if you're a big market participant, you come in on the open, you sell your equity holdings down, it leads to forced selling, pushes the stock down, and then you can buy up. Or you can do the reverse, sell on the close because of profits, leading to the stock, pushing down if people start to follow you, or the algorithms start to follow you, or the retail traders, which is a big part of the Chinese market, start to follow you. And then you buy the next day. Don't necessarily agree with what they're doing. I think the institutional hand should have an institutional hand. I don't believe you should manipulate a market, but I think you should be okay to sell whenever you want. But these are some of the measures that they're imposing to bring up market stability. And I think we need to stop expecting the Chinese to act like the Americans. They don't want to. They run under different rules. And I guess this is part of, the market crash, which is, deeper and broader than we thought. And they're looking for, fundamental reasons to support a recovery, and particularly for the Chinese consumer, which we've talked about a lot, which I think is the key to get them back and confident in their stock market. This is taken from Pension Investments, which is pionline.com. Perth Tolley, a prominent investor in emerging markets, excluding China, criticizes the government's interference as short-sighted and damaging to investor confidence. I certainly think it damages maybe institutional confidence, indicating a lack of long-term solutions. He runs the Freedom 100 Emerging Markets ETF, operated by Toll Life and Liberty Indexes, which avoids Chinese holdings, focusing instead on political and economic freedom. Sure. And then Carson Block, founder of Muddy Waters, and a notable short seller, recalls similar to regulatory actions in 2015, big market crash then, interpreting current measures as a sign of desperation by the Chinese Communist Party, CCP. Yeah, maybe I wouldn't say out of desperation. I think they're trying everything they can to stabilize this market, which probably maybe is a sign of desperation. It certainly worked this week. Let's see how it goes going on. Look, I think in the end, it's fundamentals and economic growth and the strength of the Chinese economy that will lead to long-term growth within its stock market. I certainly believe in those, and we'll talk about those as we kind of develop and hopefully get some guests on to talk about that as we go along. But we've got to build up the numbers because no one wants to come on the show if you've got 9 YouTube followers and 3 people watching you on your podcast. So spread the word, people. Spread the word. Okay, let's take a look at the Japanese chip sector or semiconductor sector, and let's have a look at how that is affecting actually China. So we saw a report during the week from Japanese semiconductor maker Tokyo Electron. It saw its value increase by 12 billion on February 13, and it cited increased sales from China. If you look at the Japanese semiconductor index or the MSCI index, it's pretty much doubled in the last year. And a lot of that has been to do with the Chinese particularly buying Japanese semiconductor machines. So it's been spurred by US trade restrictions and Beijing's push for local chip production. So if you don't follow this, China wants to build almost a closed loop circuit semiconductor industry. And that is for national security. We talk about, what is President Xi saying when he talks about national security? Well, one of them is chips. They definitely want to become as self-sufficient as they can in chip making, because rightfully so. I mean, they've been hit with so many curbs and trade restrictions by the United States that started with Trump and have only continued, if not more aggressive, under the Biden administration. Whether you agree with that or not is not the question. If you look at the Japanese semiconductors, their demand in China is growing for older generation chip making equipment due to export bans on advanced chips. Screen Semiconductor Solutions out of Japan reports a significant increase in China's sales, expecting 44% of total sales to come from China in the current fiscal year, up from 19% the previous year. China is now the largest market for many Japanese semiconductor equipment manufacturers, with expectations of growing reliance, particularly for logic and power semiconductors. So a bit of a background here. The bans were on those really complex semiconductor machines from the likes of ASML, which I think are lithography machines, and you need them to make the really advanced, super small technological chips. So they got banned. So in order to, continue their production, the Chinese started to, one, they tried to pre-purchase as many machines because they knew that the ban was coming. But 2, they kind of bought a lot of not as technologically innovative machines and used those in a combination of power to try to get their semiconductors. Secondly, a lot of their consumption of chips is lower end chips, right? They are 40% of the world's chip market in terms of demand. A lot of that is lower end chips. They can still do that. But what they want to do is produce the higher end chips. They want to compete with the likes of TSMC and AMD in terms of the production of the chips. Now they are way behind, and they've actually been trying to do that for 30 or 40 years unsuccessfully. It's a very difficult market. It takes a lot of money and it takes a lot of technological know-how. And now that they've been blocked from technological know-how, it's pushed them backwards. But they have made some significant improvements. Take the new Huawei phone, which was designed by Huawei and made by SMIC, Semiconductor Manufacturing International Corporation, which is their equivalent of TSMC, which is a fabricator making chips. So look, it's not the best chip in the world. It's not an NVIDIA chip, but it is equivalent of a 7nm chip, which a lot of the industry thought the Chinese couldn't make. And it works really well. So it was designed by Huawei, so designing that kind of chip, that technologically advanced chip, and it was fabricated by SMIC. Still a long way to go, but they want to get there because they understand the world is actually blocking them from their chips. Rightfully or wrongfully, they are being circumvented from this technology. If you talk about the trade war was not about, basketballs and TV screens being made. It was about chips. Chips are the kingmaker. You control the chips, you control the technology. They are probably the most important asset in the world. We talk about stocks like Nvidia being the most important company in the world. Well, chips are the most important because everything that we do technologically has a chip. Whether it's this microphone I'm sitting here talking to you on now, basic chip, or my Apple Mac, which I'm recording off now, more complex chip, or satellites in the air, or AI, or robotics, or the fifth industrial revolution, whatever it is, all going to be based on chips. China wants to catch up, and in order to do so, in order to continue to produce the chips that they need for their domestic market, particularly in that low-end area, they're buying them off Japanese producers who have benefited from it. And if you look at the Japanese semiconductor market, gone gangbusters. In fact, there are reports that China wanted to build, re-emphasize itself as a leading chip maker on the back of, kind of Chinese demand. But the Chinese want to build an indigenous closed circuit loop where they're reliant on themselves for their chips. They have done it to some extent successfully, but also a lot of it has been unsuccessful because they can't make that technological leap. Do I believe they will make that technological leap? Yes, they will. I believe it is inevitable that they will. One, they have incredible demand for it. Two, they will pump an incredible amount of money into it. Three, there will be countries around the world that will want to deal with them. Maybe not on that advanced arm, but there will be, and they will get there eventually, particularly as chip technology starts to slow down, because the chips can only get so small. So I think this is actually a really good sector to have a look at and to be invested in within China. They've got the big IC funds, so they're integrated circuit funds. There's a lot of money going into developing these. So I thought I will talk about some of the largest chip companies within China and give you a bit of an idea who they are. Now, I've only talked about ones that are listed on the Hong Kong Stock Exchange because they are open to foreign buyers. Any of the ones listed in the mainland exchanges are not available to you. However, I will talk about an ETF that gives you exposure to some of them in the next slide. We should go on the internet and have a look at it. It's provided by Crane Shares. The biggest one, I think, is Semiconductor Manufacturing International Corporation, and I will talk about this one the most. I actually own this. It's actually one of my largest Chinese holdings. If you have listened to me before, you will know that I was in Malaysia, in Kuala Lumpur, for a conference, a value investing conference. They asked me for my best pick within China. I talked about this company in 2020, just before the pandemic. It was at $9. It went to $44. Currently trading at just under, actually pushed over $15 yesterday. It got hit with the Trump ban, and that really scuttled it. But this is their answer to TSMC. I think they want this to become a national champion. This is probably their leading chip maker. Again, this is a fabricator. But other ones that you might want to look at, ASM, Pacific Technology. So it does assembly and packaging equipment, kind of the last end of that chip production. So there's design, fabrication, and assembly. Huawong, they manufacture semiconductor wafers for consumer electronics, telecommunications, and automotive industries. Again, on the lower end in terms of technology. But there's a lot of lower end stuff that's needed. GCL, quite small. So they're in that solar industry, semiconductor materials, and notably polysilicon. Shanghai Fudon, code 1385. I've got the codes there for you. Engaged in ASIC design, development, safe, and providing system solutions. China Electronics, Huawei Technology Company, part of China Electronics Corporation. They focus on R&D, manufacturing, and sales of electronic components, including semiconductors. And ZTE, which was kind of the first one that got hit with the ban, a global leader in telecommunications and information technologies around chips. If China get to where they want to go in this centrally planned, rudimentary market underneath it, then these companies, I think, will benefit from it because they will need to produce the chips that the Chinese need for their electronics, from cloud computing to laptops to mobile phones to, e-readers, etc. The one I like the most is Semiconductor Manufacturing International Corporation. It does a lot of production it fabricates a lot of the lower end chips, so 11 nms and below or higher in terms of size. but they eventually want to get to the 7s and the 5s. Whether they're going to get there in the next couple of years, I don't know, but I think they will get there because China wants this so badly. Because it understands that the US is no longer going to provide them with that technology, and they need it. They need it to advance. They need it to become number one if they want to be number one, and they need it for areas such as artificial intelligence, robotics. We talk about the next wave of technology. They're all built on these chips, and these are probably your seven major companies, all listed on the Hang Seng. SMRC ticker code 981, ASM Pacific Technology ticker code 522, Huawong 1347, probably my second pick, GCL 3800, Shanghai Fudon ticker code 1385, China Electronics Huada ticker code 0085, and ZTE ticker code 0763, all listed in Hong Kong. Now, if you're looking for more mainland exposure of Chinese chips, then there is an ETF that I have been looking at, and we'll go over to the websites provided by Crane Shares. All right, so this is the Crane Share size. I think these guys are the best in breed. One for Chinese ETFs, one for China research. I mean, that's all they do, which makes specialization a key here. Disclaimer, I don't own this one, but I do own their KWeb in terms of my China exposure. It's a real good ETF I like to buy. Very liquid, listed in the New York Stock Exchange. A lot of the holdings are Hong Kong holdings, so it kind of removes that delisting risk, which I don't think is around anymore, considering some of the changes that the Chinese have made. But let's just take a look. They're capturing China's 5G and semiconductor opportunities. So it's not a semiconductor index per se. It does give you some 5G components. Let's just have a look at a read here. Let me just push that up. So if you're watching, you can hear it. But if you're listening on podcast, KFVG seeks to measure the performance of the CICC China 5G and Semiconductor Leaders Index. The index is designed to track the performance of companies engaged in 5G and semiconductor-related businesses, including 5G equipment, semiconductor, electronic components, and data centers. It talks about, why 5G, how China is a leader in 5G technologies. It also talks about China is becoming, which I've alluded to, more self-sufficient in semiconductor development, largely due to government policies and funding specifically in the industry. This is why I like it, because the government wants it to work. Often China, its uniqueness of its economy is it says, okay, we want to go into renewables. Here's a whole bunch of money, okay? Figure it out, and the best in breed survive. And they really want to create a closed loop circuit where they are dependent on themselves for semiconductors. It is as important to them as food supply. China aims to produce 70% of its semiconductors used domestically by 2025 and have complete import substitution by 2030. So that's where they want to go. Don't know if they're going to get there. Some of those stocks that I talked to you about before will benefit if they get there. If you look at the top 10 holdings of this one, they got Foxconn, Xiaomi, Luxshare. Xiaomi is designing its own chips. Hygon, Buoy Technology, Noratech, Shenzhen Tran, Will Semiconductor, which is listed on the A market, Beijing Kingsoft, which is a cloud computing company, and ZTE Corp, which we just discussed. I think they dropped SMSC out of their top 10 after the ban specifically on that company. Let's have a look at the fund performance. I mean, no surprises here. It's down considering what's happened in the market. But, if you believe China can get there, or at least 80% of the way there, then these companies are going to benefit because they're going to be producing the chips or designing the chips or assembling the chips and having them in consumer electronics going forward. Real important sector for the world, not only China, but specifically important for China as they look a little bit more inward and they talk about these things like national security. And when we talk about national security, someone like, what do you mean? Well, this is a key industry where they talk about national security. Another big area is solar, which I think is going to be the leading renewable energy source around the world. China is leading the world in solar. They also, I believe, lead the world in solar chips that will fuel these solar plants that produce the energy. All right, that's a wrap for us this week. I hope you enjoyed it. Hopefully we get a few more viewers on there on YouTube and on the podcast. If you haven't considered subscribing, please do. Leave a thumbs up on the channel, leave a comment, give us a 5 out of 5 rating wherever you are listening to on podcasts. Thank you very much. I'll see you next week. And as always, good luck with your investing.